Welcome to the Apartment Operators Podcast, where you can learn from experienced operators what it really means to be an apartment operator. No fluff, no sugarcoating, just the raw, unfiltered truth of the ups and downs of operating multifamily communities.
Welcome, everybody, to the Apartment Operator Podcast. Today, we have a special guest. We have Calvin here with us. Calvin is not a multifamily operator, but he is an insurance agent that specializes in multifamily, and we thought that's going to be bringing a lot of value to you all. So, Calvin, we start with just a few seconds of you introducing yourself to our audience and telling everybody who you are, what you do, and we'll take it from there.
Perfect. Hi, everyone. My name is Calvin Roberts. I am the principal of Falcon Insurance Agency of Michigan. We are a national boutique commercial insurance brokerage specializing in serving multifamily and commercial real estate investors throughout the United States. We insure many thousands of doors in many different markets across the United States and are the go-to experts on multifamily risk management and insurance guidance.
Awesome. Okay, well, thank you for that. We're recording this podcast in November of 2022, and everybody's biggest question is, where's the market going? What's going to happen? Interest rates are raising, inflation is rising. We are in the process of learning the results of the November elections. So how is the insurance world reacting to everything that's going on in the market right now?
So there's been a lot of calamity in the commercial insurance marketplace over the last year, 2 years. And there's a few factors that are really driving all of the change and increase in cost from the insurance side of things. The first is the subject on everyone's mind, inflation. You know, if you're an insurance company and you expected to pay $200,000 in claims, and because of inflation, it turns into $300,000 in claims that are actually paid, you have to make that money back somewhere, which comes in the form of increased premiums, limiting coverage, market availability. It's been a challenging marketplace for multifamily operators when it comes to insurance placement in the last several years. And it's really been inflation driving much of that, in addition to some of the large catastrophic claim events, Hurricane Ian in Florida, that are really impacting things on the insurance side.
Yeah, and for the audience that is kind of wondering, why is inflation increasing the claims? Well, if it used to cost, $5,000 to repair a wall or replace a kitchen a couple of years ago, between COVID changing the whole logistic nightmares of shipping and the labor costs that have increased dramatically in the last few years, that's why that same kitchen that you could have fixed for $5,000 is now going to cost you $10,000, which is why the insurance industry is now suffering from all that impact, because the number of claims per year probably statistically doesn't change, but it does change dramatically of the cost that is attached to recovering those claims from the insurance. Am I right there?
Exactly. It's the frequency of losses has not gone up, but the scale and scope of losses when they do occur has increased fairly dramatically as a result of the cost of building materials going up, the cost of labor increasing sharply. These factors, in tandem with, the ever increasing frequency and magnitude of large catastrophic claim events. So events like the Texas freeze occurrence that happened a couple of years ago. I mean, that came out of the left field from the insurance industry's point of view. It's a black swan event, and it's hard to predict and account for. So when events like that have occurred with greater frequency, in tandem with all of the pressure on, building materials and labor when repairing damage, it's really a 1-2-3 punch that is driving up premiums.
Yeah, that black swan, we felt it the hard way here in Texas. And, we have a smaller property that was built in 2007, and we suffered damage because the pipes for the fire suppression system, the sprinkler system, blew up. Like they cracked and exploded in the attic from freezing, basically. And, it's like, it's Texas. nobody expects these kind of things to happen in Texas, but it did, and it was a big insurance claim. And it's not like, it's like a faucet you can drip. This is all pressurized fire suppression systems. So yeah, absolutely, that's another, like you said, another combo punch that came out of the blue, and they didn't see the damage coming, and it's impacting. And of course, insurance companies are a business, they're not charitable organizations, so if they have increasing costs, they have to pass it on to their customer, which unfortunately is us, the operators, right? So let's talk about maybe a little bit of ways you've seen operators try to reduce the costs, and then do's and don'ts, right? Where is it wise to reduce the cost, and where is it not really wise to reduce the costs?
So there are a few things that we can do. The biggest goes back to the saying that an ounce of prevention is worth a pound of cure. So by getting very proactive about your organizational risk management, you can help to prevent further increases in premium by keeping your market access available, by making yourself a attractive client for an insurance company. So one of the key things I suggest to all of my multifamily groups is that we require renter's insurance for all of our residents. And if the tenant fails to provide their own, or maybe they stop paying after a month or two and let it lapse, you can do something like a master tenant liability program where, let's say we have 1,000 doors and maybe 700 of them either don't provide their own insurance, or they stop providing their own insurance, they let it cancel, but that kind of thing. You can implement a master tenant liability program. So something like 100,000 or 300,000 liability coverage that would respond as a first resort type of claim in the event that, one of our tenants is cooking dinner one night, and, maybe they worked a long day, maybe a 10, 12-hour shift, and decided to crack open into a couple beers while cooking dinner. And they go to lay down on the couch while that oven is, cooking, and it turns into a nice little $80,000, $100,000 fire claim as a result of the kitchen combusting. By having that master tenant liability program in place, that keeps that claim off of your claim history, meaning that instead of this turning into a claim on our own policy, it turns into a claim on either the tenant's renter's insurance or on the tenant master liability program. So it reduces our loss ratio over a several year period. That makes it so that you're able to fit into the best risk pool possible. Nobody can prevent the large catastrophic apartment building burns to the ground fire, but you can cut down on the high frequency, medium intensity losses that come out of tenant negligence with such a program. So that makes it so you are able to fit into the best possible risk pool, meaning that you'll get the best insurance placement available, the most attractive companies who they have the tightest underwriting on their insurance. You are able to qualify for them, whereas you might not be able to if, last year we had 10 kitchen fire losses that could have otherwise been not prevented, but shifted to someone else's policy other than your own. So it's a proactive approach to keeping the total cost of risk down over a several year period. And by implementing such a tenant liability master program, operators are able to make insurance into not just a expense, but a revenue generating opportunity for their organization. And I'll give you an example. I recently did one for a group in Michigan and Ohio that has right around 3,000 doors under management. And of those 3,000 doors, 924 were, non-compliant with the renter's insurance requirement. So without such a master liability program in place, there would be nothing but the operator's first party coverage that would respond to a tenant negligence fire loss, as an example. Their cost per door per month was right around $7.22 for this product for 100,000 liability coverage. they might charge the resident $13 or $14 a month, to hopefully persuade them to buy their own third-party coverage.
Mhm.
And if they don't, then it becomes a scenario where they're making $6-7 per door per month. You multiply that by 924 doors, and we're looking at a very reasonable profit center for this organization.
Yeah, so I'm gonna try to break it down and for our listeners, and correct me if I'm saying something wrong here, right? So the opportunity with the renter's insurance is has multiple facets, right? First of all, if you force your residents to have insurance, right, that decreases the chances that you'll have small claims throughout the years, which means as an insured person, you'll start having a good history of not claiming. You'll have a history from your policy, right? You'll have a strong case of, look, I'm making all my to have insurance, right? And in case anything happens, right, even if it's something major, that policy could, but then that tenant policy, if it's resulted by something that started in their fault, could cover your deductible, right? That's the word I was
Correct.
looking. So,
Exactly.
so attractiveness to the insurance carriers, something that covers your deductible, that's another thing. Reducing the amount of interaction you have with your own insurance is always a good thing, right? And then lastly, the whole profit center that comes from being able to charge if they don't have the insurance. And I know a lot of the owners, the operators are doing that these days. They force it. And we actually have a much higher number in the contract because we really are not interested in making this a big profit center. We are interested in making sure everybody has the coverage. So we actually put $50 a month, right? In reality, they should only pay I don't know, up to $20 a month realistically from any of the insurance carriers out there. I also know that there are like companies like premiums, which we're not sponsored by, so it's not like that, that will basically have some kind of a deal with the operator that says, okay, every referral we get, every resident of yours that is signing up through us, you'll get a little kickback at the end of the month. And then when I spoke with you over the phone, you mentioned that program that you guys have, and that sounded even more attractive. So instead of just getting like a $1-2 per person, you get to charge whatever you want, and then you have a fixed cost from the insurance, which I think you said $7 and some cents. So that's another fantastic opportunity to create a new revenue center over there, and not just tell them they have to, but also tell them, look, I'm going to give it to you at this price, which will be competitive against every other insurance agency out there. So definitely there's multiple facets in this thing. Did I miss anything?
No, that's perfect and very comprehensive.
Okay, awesome. So we've learned something new here, right? We've learned that we can do that. So let's keep going with the do's and don'ts, right? It's like, where are the corners that you've seen operators try to cut that you should not be cutting those corners?
So I commonly see on deals that are controlled by a insurance broker who maybe doesn't do a ton of multifamily. They might have one or two big clients, and that's pretty much all that they focus on within this space. Maybe they mostly write home and auto insurance, but they happen to luck out and write a big account in the multifamily space. One of the big things I'm constantly fixing are policies that are outside of the minimum insurable value based on the co-insurance threshold for a policy. And what that means is, and I'll use a property in the Midwest, maybe Michigan as an example here. Let's say you buy a building in Metro Detroit for $400,000. It's a 8-unit apartment building, maybe let's call it 7,000 square feet. The replacement cost of that building, just for easy numbers, let's say might be, I don't know, $1 million. And we paid $400,000 as the purchase price, the actual retail value of the property. Mm-hmm. So you tell your agent, oh, well, I'd like to insure it for the $400,000 that we just paid for it. And we want replacement cost coverage because we don't want any depreciation coming into play in a claim scenario. A lot of agents might say, sure, we can do that. And the reason why that's a bad idea is because the overwhelming majority of commercial property insurance policies stipulate that you must insure to a minimum percentage of the actual rebuild value. So if we have the standard 80% co-insurance clause in this example policy, that $1 million to completely rebuild building that we paid $400,000 for on the open market, the minimum we can insure that for with replacement cost loss settlement is $800,000, 80% of the actual cost to completely rebuild should a tornado come through and wipe it off the map. Now, if we were to insure it for the $400,000 that we had purchased it for, in a claim scenario, let's say a $200,000 claim, the math would look like you divide the amount of coverage you have, $400,000, by the minimum insurable value, 80% of the replacement cost, $800,000, meaning that we're left with a 50% co-insurance penalty in this example. So in a $200,000 fire loss, we would have 50% of the loss amount reduced from our claim settlement, $100,000, in addition to our deductible, let's say $5,000, meaning that we would get a check for $95,000 to repair $200,000 worth of damage. We're paying over $100,000 out of pocket on a medium-sized loss. So that's probably the most common issue I'm fixing on policies, especially with inflation driving up the replacement cost of buildings so significantly over the past 2 years. And it's something to where I think it's better to write a policy that is within the minimum insurable value, generally 80% of replacement cost, and to do that with maybe a higher deductible than we had planned. Maybe we were doing $10,000 deductible before, but we're going to do a $25,000 deductible. But we know that that is a known stop loss amount rather than the co-insurance penalty effectively working out as a silent percentage deductible that we don't see until the claim actually happens.
Okay, so there was a lot of technical stuff in your answer over there, right? So I'm going to try to simplify that. I just happen to understand a bit in the whole insurance world because I've learned these things the hard way, unfortunately, and I can give my example in a minute. But for the most part, if you bought a building for $400,000, but it's going to cost me, let's say, burn to the ground, and I'm going to have to rebuild it, it's going to cost me $1 million, right? So this is the replacement value. And when you look at things and you go, okay, well, I only need insurance for $400,000 because if it burns to the ground, I get my money back and I'm happy. Well, that's true. But let's say just half the building burned to the ground, right? Now you have, let's say, $200,000 claim. The insurance company is going to, excuse my language here, but they're going to screw you over by saying, no, you should have insured it over here. You insured it over here. Now I'm going to make that little math trick of mine to basically say you should have insured it double that cost. So I'm going to give you half the returns. And now you're in a place where it didn't burn to the ground so you can get your money and move on. Right? It's not like I covered it for $400,000. So any damage up to $400,000, I'm going to get my money. No, they find ways to avoid paying you because that's what insurance carriers do for a living, right? Is avoid paying. That's how they make money. So you really want to understand the difference between your replacement value and your actual coverage and what happens when there's partial claim, because it's very simple. When it's a total loss, right, you will get that $400,000, right? But anything partial, they have math and they have equations, and they have those little clauses in the policy that nobody ever sees, right? So think about it and go look at your emails. When you talk to your insurance agent, they usually only send you the declaration pages, right? Just the certificates, just shows the highlights. They don't send you the full policy unless you specifically request it. And when you do, you get like 300 pages of legal language. And in that 300 pages of legal language are buried all kind of opportunities to avoid paying you money. So you can go the hard way and literally read the whole thing, the whole 300 pages, so you know exactly where the gotchas are, right? Or you have to lean on a honest insurance agent that will mostly tell you most of those things, but not all of those things. One of the things that we've learned the hard way is, we mentioned the big Texas storm a few minutes ago, and we had a property, not the one I was telling you before about, that had a bunch of units flooded, and then one of the buildings was mostly vacant. So we didn't have electricity on in those units. And somewhere in those 300 pages of legal language, there's a clause that says that if there's no electricity or heat in that unit, if you have any damage from freezing pipes, it's not covered. But it's not something that when you call your insurance agent and say, hey, I got a multifamily property, I want to put insurance, if you're in Texas, they're not going to tell you, well, you got to have electricity on or you got to have heat on if you want to be covered against frozen pipes, right?
Yeah.
Nobody will tell you these things. And there's a lot of those gotcha places in those policies that listening to a good, honest insurance agent is going to save you a lot of money and a lot of heartburn, really, on the after fact of things.
Yeah, no, I agree completely. It comes down to, you need to work with someone who is knowledgeable within this space, not just commercial insurance, but specifically within the multifamily and commercial real estate scene. Because, I look at it this way. I do a ton of multifamily properties. That is my specialty. That's what I focus on. But if someone came to me and they had a manufacturing company, mom and pop, privately owned, that was doing 75 million revenue, I'm going to try to bid that, see what I can do. But it's also outside of where my experience and principal knowledge is within the field. So you could realistically find a better result from someone who specializes in manufacturing, as an example, to where I would probably just decline the quote. If I can't do something well, I'd rather be upfront about it and just say, it sucks. I'd love to work with you. This is a great opportunity, but you can be better served elsewhere.
Yes. And again, to mention something you said earlier, all those opportunities with the renter's insurance to reduce your total premium cost by getting those better insurance carriers, or get more coverage for your money or get the same coverage for less money. Every dollar that we save on the insurance cost is going to be straight into the NOI, right? And increase our property value. So again, it's a fine balance between where can I save money versus how much coverage do I have. But it is, when you get the same coverage for less money because you did all these things, then you find the right insurance agent or you find the right carrier, then that's money that goes straight to the bottom lines, to the NOI, and obviously NOI impacts property value.
Absolutely. And by working with someone who is knowledgeable within the space, you can generally find, assuming that there is an opportunity to improve on the account, a better premium with better coverage. Now, I go to the example of a middle market account I wrote last year with around 1,100 doors in Michigan and Ohio. And they were with one of the big top 100 national agencies previously. But to them, that other agency, this insured was just another big account. They have lots of middle market accounts, so they weren't getting a ton of, personalized service or dedicated thought and effort into the account, like, a account several orders of magnitude would demand from such an agency. I came in and I was able to bring their total insurance spend down right around 22% year over year. And we went from actual cash value across the entire portfolio to, I wrote replacement cost on probably 75% of the portfolio, with the remaining properties as ACV, just because that's how it was before. And they wanted to keep those locations ACV to keep the cost down, help with the NOI on those locations. But I was able to come in and reduce their total insurance spend by right around $70,000 a year and
That's a lot
massively
of money.
improve their coverage. Which that translates into another acquisition every year or two,
Yeah.
So it's a lot of cash flow that has been freed up by revisiting the account with, truthfully, someone who wanted it more than the existing broker.
Yeah. Here's another gotcha clause that the insurance agency love to do with the ACV. ACV stands for actual cash value. So, for example, if you have a roof and the roof is 15 years old and the lifespan of a roof is 30 years and you have a claim on it, now all of a sudden you only get half, right? Because the roof has been half his life already done. So you're replacing a roof that is 15 years old. So there it is. So know your property, know your roof's age, know all your other components' age, because ACV actually means you're going to get less when there is time to do a claim. So
exactly, they come in with that depreciation penalty, and it's not what is expected by many investors, because they're thinking, I got ACV coverage, I want to base it off close to the retail value of the property. I didn't want to insure for twice that. But then when the claim happens and they're paying half the loss or more out of pocket, that stings.
Yeah, that's big. And again, same comments just from the other side of things, that goes straight to your NOI and impacted in just the wrong way. So I have a note that you mentioned something about no drugs on premises. What is that about?
So I think it's a good idea to have several clauses written into your lease in conjunction with speaking with counsel. The first would be, if you're renting residential multifamily properties to individuals or families, it's a good idea to stipulate in the lease that there are no illegal drugs that will be kept on premises. And the main motivation behind that is that, let's say your resident has a friend come over, maybe it's an 18-year-old kid that you're renting to, and one of his buddies from high school comes over, and maybe they're doing illegal substances that they shouldn't be, and the friend who is visiting overdoses and passes away. They could try to come pointing fingers at yourself, the multifamily operator, saying that you were negligent in renting to this person. So by having something like that strictly written into the lease, it gives you something to stand behind should something like this unfortunately make its way to a jury trial. So it's, rather than in a nightmare scenario like that, trying to fumble together a defense, it gives you something concrete to where you said, don't do this, and they ignored you, they broke the rules, rather than it never being addressed in the lease. So I think it's a good idea to have a no illegal drugs clause in the lease. I also think it's a very good idea, especially if you have, a parking lot for your apartment building where residents can park and store their vehicles. And I actually took this idea from a large national property group, McKinley Properties, who I read through their entire lease agreement, took notes on things I thought would be good to implement elsewhere. And I'm presuming that over the last 6 decades that they've been in business with right around like 60,000 doors under management, they've probably learned these things the hard way from experience. But I think it's a good idea to write into your lease that if a resident intends to park their own vehicle on premises, that the landlord and property management company and building owner are expressly not liable for any damages, theft, a tree branch from a neighboring property falling on the car. Because if something like that happens and they do not have their own insurance, and maybe they needed that vehicle to get to and from work, and this caused a real problem for them, they're going to come pointing fingers every which way, and they're most likely going to come after the landlord because, hey, the landlord has all this money type of approach, especially with their attorney egging them on. But by stipulating you are expressly not liable for damages that occur to the resident's personal auto kept on premises. It helps to diffuse those kinds of situations before they even have a chance to make it to court. Because if you're an attorney and this person, a resident of an apartment complex, comes into your office and says, hey, a tree that was hanging above my car that I parked under had a branch fall over in a windstorm and it totaled my car. I want to sue the landlord. They're probably going to ask for a copy of the tenant lease agreement. When they see that you are expressly not liable in claiming as such, and that you encourage them to purchase their own insurance with comprehensive and collision coverage, it might dissuade someone like that from taking this case on a contingency basis, rather than it's just not being addressed in the lease.
Yeah. Okay, that makes sense. So we talked about the renter's insurance. We talked about the landlord's insurance. What about other entities that are on or around our properties, like vendors, suppliers, and so on? What's your thoughts about that?
So there's a couple thoughts. I'm a big believer in not hiring a lawn care company or a snow removal company unless they prove that they are insured properly. So on the general liability side, you want to be named a additional insured, so that if the arborist you hire to trim a tree accidentally knocks it over or otherwise does damage to someone else's property, that their insurance would respond with a mutual defense clause protecting your organization, rather than that turning into two insurance claims, one on the vendor's insurance and another on your property policy. So it, again, keeps these claims from going onto your history, falls back onto the responsible party's insurance, and their insurance would have a duty to defend your organization. So I think that's really a full stop requirement if you're going to be hiring contractors who will be on premises. You hire an electrician who maybe does a not great job working on the electrical of the building, and it causes a fire, and maybe someone passes away in that fire. That could turn into a claim on your insurance as well, but it's better if it falls back onto the responsible party in this scenario. So I think it's a good idea. Really, it should be a full requirement that any vendors who will be working on or servicing your property should have their own general liability insurance and name yourself as a additional insured. And you should also require that they have a copy of workers' compensation. So get a certificate of that. It has to be named an additional interest on that for reporting purposes. That way, at the end of the year, on maybe your property management company's workers' comp audit, when they ask, hey, did you hire any contractors over the last year? You can say, yes, but they proved they had their own workers' compensation insurance. That way, that doesn't become premium that you are responsible for paying, because your workers' comp policy would otherwise pick that up.
Yeah, that makes total sense. So, okay, are there any other tips, tricks, suggestions you have for our listeners before we kind of wrap these things up?
There's one other concept that it's becoming more popular over the last several years with the insurance marketplace hardening, and that is a captive insurance program. With a captive, you are the insurance company. It's a licensed insurance entity, and it really works best for those organizations who say, hey, I pay $500,000 in premium or greater, and we've only filed one claim in the last 5 years. It was for $50,000. We don't really have claims like that. We run a tight ship. Maybe we have sprinklers in our buildings, we have fire extinguishers, and we implement risk management best practices that make us a desirable insurance account. A captive insurance program is an entity to where it is controlled by the member. So you would essentially own an insurance company for your own self-use purposes. And this doesn't work with everyone, but if you're paying right around $500,000 in premium or greater, and you have a significantly better than average loss experience, maybe your loss ratio, the amount of claims paid out, money paid out in claims versus the amount of premium that you pay is somewhere around 20% paid out versus what you pay in. A captive would probably make sense for you, depending on the scale that you're at. And it works well for the captive owner in two ways. One being that you keep the underwriting profit, premium minus claims that you pay into this captive. And two, you keep the investment income that is generated. So it's like how Berkshire Hathaway made most of their money, not necessarily on the profit from underwriting, premium minus claims, but that they have all of this money and cash flow coming in that is otherwise being invested until it's used to settle claims at a later date. So you can really profit from those two avenues and make this into not an expense for your organization, but another potential revenue center.
The double end in it, basically. It's interesting. I've seen the captive insurance work in small things like insuring the cars, insuring the office supplies, and electronics and stuff like that. I haven't seen anyone do that on the larger real estate side of things, because one catastrophic event and you're underwater, right? So it's kind of like, to pay $500,000 in insurance, you got to have multiple tens of millions of dollars of real estate, right? One of them goes underground and you need about 10 years worth of that $500,000 to cover the issue, right? So it's kind of like it's a risk reward kind of factor, and in that case it's a high risk.
And for something like that, you can help to balance the risk by purchasing reinsurance for your captive. So reinsurance it's insurance for insurance companies. So for example, I'm just making numbers up for hypothetical here, but let's say State Farm has a reinsurance treaty that triggers after $5 billion in hurricane losses over a calendar year. If one year they have a bad season and they pay out $10 billion in claims, they would get that $5 billion after their initial threshold is met, returned to them by a third-party reinsurer. So your Munich Re, your AIG, there's lots of reinsurance companies. I mean, you could purchase a Lloyd's of London reinsurance treaty or something along those lines. So
that's definitely an interesting concept for the larger companies out there, right? So I'm sure some of them will reach out and say, hey, talk to me. It's interesting, right? So just to respect your time and our audience, anything you would like to say before we wrap up, or where can our audience find you, right? If they want to reach out, they want to talk insurance, they want to get a quote, maybe get a list of those good to know, add these to your list kind of clause, how can they reach you?
My email address is Kelvin, spelled like Kelvin Klein, CALVIN, @Falcon, INS, short for insurance, agency.com. And if they are inclined, I'm available on LinkedIn, Facebook. You can reach me in quite a variety of ways, and I'm incredibly responsive.
Awesome. We'll put the links in the show notes as well. Calvin, that was very educational. I've learned a lot. I hope I've learned some things as well. Thank you so much for coming up on the show.
Oh, thank you very much again for having me. It was my honor and pleasure.
Awesome. And for you, the audience, if you want to hear more about multifamily, please go give us a review. It doesn't matter 1 star or 5 stars, just give us a review you feel is right on iTunes, on Stitcher, on SoundCloud, wherever you consume your podcast, and subscribe. We're looking forward to another episode coming up soon.
Awesome. Thank you again very much. Hope you have a great day.
Thank you for listening to our show. If you want to enjoy more episodes, please subscribe on iTunes, YouTube, Stitcher, or SoundCloud. For questions or feedback, please visit our site at www.aptopr.com.